It takes a couple of minutes for everyone to join. I guess we'll get started. So welcome everyone to our quarterly market update. We very much appreciate that you found time to join us today. And for those of you who already know me, again, great. Appreciate you joining this webinar. And for those of you who haven't met me yet, well, I'm Alex Selesnev. I'm a certified financial planner and chartered financial analyst. So my background is really in financial planning and investments, and I've been helping clients with their financial planning goals for over 15 years now. I'm the founder of Capital Squared Financial, and our firm really specializes in transitions. So of course, your transition into retirement, which is perhaps one of the most transitions you'll ever make, and you want to make sure that you avoid, avoidable mistakes. So that's one of the primary reasons why our clients reach out to us. Divorce, of course, that's a major life event, and specifically post-divorce planning. That's when we really help our clients essentially revisit their overall financial plan and build a new one for them. There are other life transitions. Marriage would be one, perhaps more on the positive side. Inheritance is another reason why people reach out to us. But again, we specialize in transitions of that nature. We've partnered with some of the top providers of research and analytics. So as a result of that, we're able to provide truly individualized investment strategies to our clients. There are no cookie cutter models here. We want to make sure that each and every investment policy matches our client's specific needs, and it can be very custom. Now, what truly makes us unique is the fact that we do provide proactive tax planning services to our clients, which is what most advisors rarely focus on. And we do want to meet with our clients usually semi-annually to make sure we focus on strategies to minimize their taxes in the current year and of course in the long run. We're fully independent. We're a fee-only fiduciary firm, and essentially what that means, anytime we provide any advice to you or recommend some kind of fund or some kind of stock, it has to be in your best interest. So that's what a fiduciary standard means. And there's really no compensation to us beyond what our clients pay us directly, so that eliminates that potential conflict of interest. And then finally, which is what I would say most of our clients really appreciate about us, we are very responsive. We always get back to our clients within 24 hours. We try to resolve their issues within that time frame, or at the very least acknowledge it. So of course, if you want to learn more, feel free to reach out or simply visit our website. So in terms of our webinar today, again, there's three objectives. The first one is, of course, to update everyone on where we are today. The second objective is to share some of our ideas. And of course, if there are any questions, we do want to address them in real time. So in terms of the markets, and the data I have here is as of last Friday, hasn't changed all that much over the past day and a half. The markets are up over the past day and a half or so. So domestic large cap stocks, as measured by the S&P 500 index, are up by almost 13% as we speak today, which is certainly quite healthy. Now, growth-oriented stocks, or specifically those that are included in the NASDAQ index, are up by almost 38%. It says there 36.96 on the slide, but they're actually up by almost 38% as we speak today. And there's a lot to be said about that. We'll talk about that more shortly. Now, domestic small cap stocks, are essentially more aggressive stocks, are essentially flat for the year, which is not surprising because interest rates are so high, and there's still that expectation that perhaps they'll stay at that level or maybe even increase in the future. Developed international markets are up by 4.5% or so. Today, in our webinar today, we're not going to focus much on international markets, but I'll just mention that earlier this year, developed markets specifically, they were the top performing category, but not anymore. Emerging markets are flat for the year. And again, without going into too much detail, that's a very broad category. There are different markets, of course, different countries, and they can perform very differently. But as a category, they're flat for the year. And then finally, domestic bonds or the domestic bond aggregate is in the negative by almost 5%. Now, in practice, at least in terms of how we work with our clients, we would rarely recommend that they invest in bonds this way. There are, I would say, better options, which again, something we'll discuss today. In terms of the 10-year Treasury yield, and I understand this is like such a technical term, but think of it as the market's interest rate, which essentially impacts everything. There are a lot of different relationships, and one of them, when interest rates go up, more often than not, stocks go down. That is not always the case, and again, 2023 is an example of that, of the opposite essentially. But usually, higher interest rates, do not create necessarily a very positive environment for the stock market. Same for bonds, by the way. There's this inverse relationship between the bond prices and interest rates. Even though you're essentially getting better yields on new bonds, they've been recently issued, but in terms of your existing bonds, their prices tend to go down. Finally, in terms of the sector performance, and it's interesting, when I was preparing for this webinar, well, communication services and information technology and also consumer discretionary stocks are up by anywhere between 37 to 44% for the year. So they're really leading the way. And then more conservative stocks and in the utilities and consumer staples category are down anywhere between 10 to almost 20%. There's really two things you can learn from here. You can hopefully clearly see what sectors are driving the markets. And second, for those of you who are more conservative, and every so often I hear that, like utility stocks, they cannot go down. Well, that is certainly not true, at least not in the short run, as you can see on this slide. So this is where it gets more interesting, at least for someone like myself. So when someone says that the markets are up by 12, 15 or 20%, that doesn't necessarily tell you the whole story. So what you're looking at here, you're looking at the performance of different essentially sub-asset classes or different styles is how they call them, year to date, so for the first 9 months of the year, and then for last quarter, for the third quarter of the year. So I'll start, and again, before I do that, just for those of you who are less familiar, so growth stocks here on the very right, as the name implies, these are more growth-oriented companies, and essentially anytime they earn revenues, anytime they have any kind of earnings, they tend to reinvest in themselves. So as a result of that, their share price tends to increase in value at a faster pace. They usually don't pay that much in dividends, and they tend to be much more volatile than other types of stocks. On the other hand, on the left side here, you have so-called value stocks, and in many cases, these are more mature companies. They've been around for many years. Usually, they don't have necessarily any great growth prospects, but at the same time, they tend to focus on dividend payments. And then the core category, which is in the middle, is essentially in between. There's some growth prospects, but they tend to be more mature in terms of their business cycle. And just to give you some examples, so technology stocks, I'm going to say most technology stocks are in the growth category. On the value side, you have financials, you have utilities, energy stocks are on the value side, and then core holdings, so it's a perfect example of that would be healthcare stocks. Not necessarily all of them, but specifically larger healthcare companies, they're in the middle. So what can we learn from this chart? Well, again, if you look on the left side, well, the markets were down by 3% last quarter. So again, that was a reminder that they do not always go up. And notice that most of the losses really happened on the growth side. So if you're invested in more conservative stocks, well, perhaps you wouldn't even notice it that much. Year to date, again, the markets are up by more than 13% as we speak today, but most of those gains are really coming from the growth category, specifically large cap growth stocks, and I've encircled them on the chart. They're up by more than 27% for the year. Now, if I'm not mistaken, at the end of the first quarter, there were 10 or 12 large cap stocks that were responsible for more than 90% of the market's performance. So again, that really tells you that there's maybe a few dozen stocks that are really driving the markets year to date. Now, those are short-term performance results that may not really be all that important, and it's always good to keep things in perspective. So again, I've said this multiple times that growth stocks are doing so well year to date. But if you look at their performance over the past 5 years, and I know it will look different if you analyze it over the past 10 or 15 years, notice that they performed very similarly to more conservative, I would say, core holdings. So again, there's that idea that in the long run, there's that return to the mean concept that many categories, they tend to perform somewhat similarly. That is certainly not the case on the value side, and that makes sense because again, many of those companies are more mature, they're more dividend oriented, and they're not necessarily expected to grow as much in the long run. And the other piece, which I'd like to assume that it's obvious, but I'll say this again. So in the long run, you should not expect any category essentially to perform at 20+% per year. And again, I know it sounds obvious, but sometimes that's what people expect. And then when it doesn't happen, they become frustrated. In terms of the market outlook, so here I really wanted to focus on some of the top ideas that at least we are, keeping in mind. Well, we do believe that the markets will continue to be driven by interest rates. And again, for those of you who know me, I've been saying this for several quarters now. Well, what you don't see here on this chart, on their slide, I should say, we're in the very beginning of the third quarter earnings season, and so far it's been mostly positive, but it's hard to, or too early to tell exactly what it would look like at the end. There will likely be some impacts. They say the markets are driven by earnings, but at the same time, again, what happened in mid-September when the Fed came out and basically said, look, we're going to keep interest rates at this level for longer, and they're potentially expecting at least one additional rate hike. Again, that's when the markets really declined rather quickly. So that's why we believe so. Now, also expect interest rates to remain high for some time. And of course, some time, that's an interesting idea. Are we talking about 2 quarters, 3 quarters, maybe 4? Again, depending on who you ask. Some people, they have a lot of wishful thinking that perhaps it's just going to be a couple of quarters, and by mid-2024, interest rates will begin to decline. But ask yourself, what if interest rates remain high for longer, maybe for a few years? Exactly how would that impact, in the context of our webinar today, your portfolio? Would you be more willing to buy bonds, with better yields, or would you stick with your existing portfolio of, let's say, existing stocks if you're mostly invested in those types of asset classes? Again, I'll touch on more on that separately. There's this one of those golden rules of investing. You don't fight the Fed, and many people attempt to do so. And again, for those of you who watch the markets, like this morning, this is what I read this morning. Stocks open slightly higher in hopes that the Fed is done with rate hikes, essentially. But who knows? It's speculative. Again, I've been reading the commentary, the Fed commentary every time it comes out, and so far they are on the mission. They are planning on keeping interest rates high. They want to make sure inflation continues to decline. So again, don't fight the Fed. So overall, we remain cautious in last quarter of the year. That's where we are at this point. So market swings, should you be concerned? Again, that was one of the bullet points for this webinar. Well, to answer that question, you need to have at least some understanding of how the markets work. And one of the statements I tend to make in conversations like this, well, the stock market is inherently volatile, and that's just that. It's always been the case, and chances are it will remain to be the case going forward. One observation is, over the past, couple of decades, actually, it feels like the markets are becoming even more volatile. So the chart or the graph, I guess, that you see on the slide is actually a good representation of almost any period in the stock market. 10 years, 20 years, 30 years, you always see, it always looks like a wave in some sense. Now, what's also important is that market highs are often followed by significant declines, and that's just that. And as I mentioned earlier, what happens in years perhaps such as 2023, when people look at their monthly statements or their quarterly statements, the account balances continue to go up. So in some sense, they fall asleep. It's like, okay, I don't have to do anything. It just goes up, up, and up. It's so pleasant to look at it. And then all of a sudden, the markets are down by 10%, 15, maybe even 20, and they're surprised. But there's no reason to be surprised because that's how it works. No one can essentially predict exactly when that happens, when the so-called corrections happen, when the markets are down by 10% or more. But that's, again, how it works. The other piece is, again, in the long run, most swings are really market noise. And just as a quick reminder, see how many of you even remember that earlier this year, there was this big issue with the banking industry, and quite a few of our clients actually reached out and they were quite concerned. I haven't heard anyone even mentioning anything about that, today or the past couple of months, and it's only been 6 months or so. So again, a lot of that is really just that, it's noise. Now, if you dig a little deeper, you don't necessarily have to go that far. Well, what's the primary reason for this concern, in terms of the market swings? Well, perhaps the answer to that question is, lack of planning. Again, you don't have a plan for a situation like that, and that's important. That's something that's usually addressed in your investment policy. Well, exactly what would you do when the markets are going up, right? Would you be rebalancing? And if you decide to rebalance, exactly how would you do that? What happens if the markets are down by 10%, 15% or more? What would you do in that case? So when you think about that ahead of time, it's much easier actually to adjust and even take advantage of the markets. Now, in the long run, in terms of when we work with our clients and we spend a lot of time on education, actually, the best way to think of the market swings are as opportunities. Think of them as opportunities. I'm sure everyone heard this. Certainly, it's a golden rule of investing: buy low and sell high. Absolutely, but how would you buy low if the markets are always going up, right? It's when they begin to correct, it's when they're going down, you tend to have those opportunities. And in terms of selling high, again, back to looking at your statements every month or every quarter, well, that's the time. Again, you don't necessarily want to fall asleep and expect that it's just going to grow over the moon. The other idea here is, again, if you for some reason accumulated a lot of cash, perhaps you sold the property or you received some kind of bonus for any other reason, usually it's more challenging, or at least it should be, to invest when the markets are going up so rapidly, because there are really not that many bargains in that case. But when the markets begin to go down, again, usually that presents that opportunity for you to do so. So again, market swings are opportunities. So recession, inflation, now what's next? And even though perhaps those concerns are not as apparent today as they used to be perhaps 6 to 12 months ago, there's still concerns. So in terms of the recession, I'll just go ahead and say it. I'll make it simple. I'm not going to talk about this for a long time. It's unlikely at this point. It's really unlikely. If you look at the numbers that we have, I'm not saying it's not going to happen. All I'm saying is if you're focusing on the next couple of quarters at least, there's just no indication that something like that is going to happen. Now, as a reminder, again, if you go back 12 months ago, and I remember many conversations with my clients and some of my colleagues even, the idea was that the recession is imminent. And the only question is, are we talking about a hard landing, which would be, really bad essentially, or would it be more of a soft landing? Essentially, the Federal Reserve Bank or the Fed would be able to engineer, the situation when the economy declines just enough so that, there's not much overall damage. Well, none of those things happened. And there's just that, a lot of people predicted that, a lot of top economists predicted that, but that never happened. And I'm not saying that you should, avoid thinking about that necessarily, but it's always speculative. Now, over the past couple of months or so, start hearing about this new scenario. It's stealth scenario. Perhaps there are other names, and essentially what it implies is that there's some pockets of our economy where the recession already started. Perhaps again, and when you talk about real estate and related services, but we're not seeing the impact on the overall economy yet. Inflation expected to gradually decline. The Fed's target remains at 2%. There's a different formula at this point, but frankly, it's not clear exactly when they'll accomplish that goal, but they're certainly on the mission to accomplish it, and they'll do whatever it takes to keep it low. So again, keep that in mind. Now, in practice, and again, I'll just say it, there's really not much that we can do about it in terms of you being an individual investor, but you can prepare for it. So if this is your concern, and perhaps you believe that it will impact your job or your employment opportunities, well, one of the best ideas is to keep more in cash reserves. I would normally say 3 to 6 months. If it's more important for you, you can maintain anywhere between 6 to 9 months. And especially now, you can find a money market account that pays you more than 5%. So you're actually getting, decent return on keeping your cash. So that's one idea for you to keep in mind. Rebalancing your portfolio, that's key. And I would usually say that closer to the end of the year. I believe everyone should rebalance their portfolio at least annually, in some cases more frequently. Specifically, again, as we discussed earlier, when there are certain categories like growth stocks that have been outperforming everything else by such a large margin. So again, if you have any of those in your portfolio, I would certainly revisit that. Now, here's a very important point here. For those of you who are thinking about retirement, or perhaps you're already in retirement, make sure that you revisit and potentially adjust your allocation to bonds. Because again, things changed, I would say, dramatically over the past 3 years. Remember, pre-pandemic, interest rates were so low that keeping more than absolutely necessary in bonds, well, people would just say it's a bad idea. Some of my clients, they used to even complain. They're like, Alex, why are you doing this? Why are you keeping this, our hard-earned money in something that pays us 1%? Well, again, at this point, bonds are paying more than 5%. So if you're, again, thinking about retirement or you're already in retirement, we usually recommend that you maintain roughly 7 years of your projected cash needs in bonds. And where 7 years is coming from, that happens to be this average business cycle in the US. Essentially, that's how long on average it takes for the markets to go from the top to the bottom, and then from the bottom to the top. So again, make sure that you do that if you're concerned about a potential recession. And that actually, in terms of the bonds, that's another bullet point that we wanted to cover today. Well, bonds are your ally in today's market. Well, why is that? And again, for those of you who are perhaps less familiar with how bonds work, well, they do have predictable returns. That's one of the benefits. Again, very briefly, so if you buy a bond today that matures in 3 years and pays you 5%, and let's say you buy it for $1,000, well, essentially what's going to happen, you'll get your 5% interest, usually on a semi-annual basis, and by the end of year 3, you'll get your money back. So as a result of that, again, the returns are quite predictable. Given where we are with interest rates, we suggest that you focus on shorter term bonds. And again, this is something I've been saying for quite some time. We are looking at bonds that have longer maturities, 3, 5, maybe even 10 years, but I do not believe we're quite there yet. There are some situations perhaps for you to consider that, but say for most people, focusing on shorter maturities makes a lot of sense. Attractive yields, that's perhaps one of the best reasons. 5.5%, perhaps even higher than that if you're staying on top of that. With inflation at 3.7, well, that is now attractive. It's also important if you have a financial plan in place, and of course I'm biased. I believe everyone should have a financial plan in place. It can be a one-page plan, but it's important to have it in writing. Well, by keeping more in bonds, chances are you will keep your financial plan on track. Why do I say that? most projections, they assume that your long-term rate of return will be anywhere between 5 to 7%. So when you have bonds paying you 5.5%, essentially tax-free, if you focus on, let's say, domestic treasuries, well, chances are, again, it will keep your plan on track. And then finally, which is more of a, I'm going to say, technical point, usually more for professionals or those investors who try to stay on top of it, can also help you take advantage of the market volatility. Because what usually happens, not always, but usually, when stocks go down, bonds go up. So if you have more in bonds, you can sell some of them and buy stocks at lower prices. I very much simplified it just now. It doesn't work exactly this way, but that's the idea of having more of a buffer. So in terms of the summary, in terms of our top ideas for today, we do believe that this is a good time to rebalance your portfolio. As I mentioned earlier, we recommend that you do that at least annually, even in a positive year like 2023 so far, because again, the stock market doesn't always perform in a uniform fashion. Like this year, again, growth stocks significantly outperformed every other category. Chances are, again, if you have a diversified portfolio, there will be opportunities for you to harvest losses for tax purposes. We'll have a webinar on November 15th, actually dedicated to different year-end financial planning and tax strategies. But the way it works, let's say you have a small cap growth fund or small cap value fund as an example. Let's say you purchase it for $1,000. Let's say it actually declined in value to $900. So you would sell it. You'd capture that loss of $100 in my example for tax purposes, and then you would repurchase a similar fund, but it has to be not identical, essentially not the same fund, so that you keep your asset allocation at the same level. This strategy, if you do it consistently and continuously, can really save you a lot of money in taxes. In terms of, again, if you're focusing on rebalancing your stock allocation and you sell some of your growth stocks, well, where would the funds go? And if you want to keep it in stocks, I would suggest, again, core holdings. And, in our webinar today, of course, the public event, I cannot provide any specific recommendations, even though we certainly have them. But again, healthcare would be a good example of that if you're looking for different sectors. If you're thinking about investing in growth stocks, well, my comment on that would be, well, be careful. Because again, they're already appreciated by so much, and even within that category, some of the top holdings, they're up. One of them is actually by like 150% this year. So be careful. Now, if you're going to buy and hold it for a very long time, well, perhaps you'll be fine. But in the short run, again, when anytime the markets go up that much, there's always that possibility or even probability that they will decline just as quickly. In terms of mid and small cap stocks, these are more aggressive, more interest rate sensitive stocks. We're neutral on them at this point. We're not necessarily planning on adding more for any of our clients. We really want to make sure that interest rates at least normalize or hopefully begin to decline before we do that. And then finally, in terms of bonds, again, bonds are your ally in today's market. There's really a lot of applications. If you need more income, if you're more of a conservative investor, thinking about retirement and you want to have that buffer or bond ladder, this would be a good time to revisit that. And even if you're growth-oriented investor and you're just not entirely comfortable with the markets today, perhaps this would be a good time to consider bonds.